newsmakers, and market movers. This is The Pulse with Francine Lacqua.
Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. Happy Friday, everyone. President Trump then announcing a fresh round of tariffs targeting a broad range of sectors, including, as I mentioned, a 100% duty on branded or patented pharmaceuticals starting October the 1st. For any company not building, and this is important, not building a manufacturing plant in America. Let's bring in Sam Fazeli then, senior pharma analyst at Bloomberg Intelligence. Sam, given that many of the most imported drugs to the US are made in countries with existing trade agreements, trade deals with the US, what is the likely impact of these measures, again, set to kick in on October the 1st?
Hi, Tom. So I think if you read through the short comment that the president made on Truth Social, all it seems that companies need to do to avoid this, whether it's the 100% or within the existing tariff structure, which of course there's so little information on that front that we can't really know what the actual reality will be. But as long as they're in the process of transferring some manufacturing or about to be building a manufacturing site, and they've had about 3 months to get going, a lot of pharma companies have got going in some new manufacturing facilities, whether they were expected or not, whether they were related to tariffs or not. So I think many farmers will not be impacted by this. And actually, you can see that in the share price moves now. Pre-market, they looked a bit ugly, but I think most people have kind of sat back and thought, wait a minute. This is, and also you cannot suddenly double the price of a drug in the US, which was already complaining about high prices of drugs.
OK, so maybe the nuance is slightly less concerning for those companies than the headline suggests. And we've seen that before, haven't we, Sam? So you're giving us the context Absolutely. On that front. When it comes, Sam, to what this does, though, to supply chains, you know this better than most. They are complicated. They're interwoven when it comes to the pharmaceutical industry. Is there at least a risk around just adding complexity, adding cost, adding time around those supply chains?
Yeah, I think, Tom, there is a possibility that there is a risk there, which is why I think you might see some share prices looking a little bit weak. Again, the market hates uncertainty here, and it does add an element of that. But the reality is that I think the administration has been quite pragmatic on some of these things, where if you're at least finishing the product, doing a major amount of the manufacturing in the US, whether you get your culture media or sodium chloride that you need to add. I'm just making up some points here. And from I don't know, Canada or Mexico, I don't think that is going to be the issue. I think the key thing here is that the president is trying to push investment in the US, not just a small amount of income on some cheap ingredient that goes into a basic manufacturing facility. And I think this is the objective of this effort. And there has been some positive response to it. And some companies have started doing that.
OK, there is that rationale then. Sam Fazeli from Bloomberg Intelligence, really important context and framing of what we've been hearing in terms of these latest measures and tariff threats targeting the pharmaceutical industry. Now, to the broader macro story, revisions to US data show that second quarter GDP was higher than previously reported, with consumer spending particularly strong. The adjustments suggest that the balance of risks to the Fed's dual mandate could be shifting back towards inflation from the labour market, of course. Speaking just before the revision was published, Fed Governor Stephen Miron repeated his call for more rate cuts.
My view is not one of enormous economic pessimism. I don't think the economy is about to crater. I don't think the labor market's about to fall off a cliff. However, the neutral rate is drifting down. And as a result of that, it's incumbent upon policy to adjust in response. And the longer that policy stays excessively restrictive, the greater the risks to the downside for the economy.
OK, let's bring in at this point Nataliia Lipikhina, head of EMEA equity strategy at JPMorgan Private Bank. Nataliia, great to see you. Thanks for coming in this Friday morning. So given where we stand in terms of the uncertainty that many investors are now starting to think about when it comes to the Fed's path ahead, and there is clearly that debate amongst FOMC officials when it comes to labour and inflation risks, and then the tariff news over the last 24 hours, do you maintain your constructive view on the US equity markets?
Good morning. Thank you, Tom, for having me. We actually do maintain the positive view because when we look into the tariffs, we've been living with tariffs since the beginning of the year. And most likely the uncertainty actually peaked in April period of time. We saw a very big downgrade cycle to earnings since April time. Now, what is really interesting, when the companies have been reported in the first quarter, in the second quarter, we're seeing really strong revisions, especially after the second quarter. Second quarter earnings, the market was expecting 5%. Companies came up with 12%. So clearly we're seeing that the corporate environment still remains quite constructive. And we think that probably this earnings growth will continue into 2026.
Okay, so the earnings growth continues. How much of that is premised on a dovish Federal Reserve? What are your expectations as to how far this Fed can go, given the challenges on both sides of their mandate?
Absolutely. And we think that the Fed cutting cycle is actually supporting for the risk assets at this point because we are still in a solid macro environment. We're not seeing a recession. And usually when the Fed is cutting and the macroeconomic environment is still solid, that is usually good for the risk on assets, equities. We're constructive on the US market and we're also constructive on ex-US market. When you combine that with a solid earnings growth, that gives you and us a very constructive picture.
Okay, so the markets and earnings have kind of, you're suggesting we can look through the tariffs to some extent. I just wonder on the inflation story, though, is there at least a risk that investors need to be thinking about when it comes to 2026 and a possible resurgence of inflation that in the US is still well above the target of 2%? We're around 3% on inflation. We have additional tariffs. Is there a second wave inflation risk?
There are a couple of ways to think about this. Absolutely, this is potential risk, but we're not seeing a massive resurgence in inflation. Can there be some bumps because of the tariffs? Absolutely, there can be. The question is, when we talk to investors, how we'll think about the portfolio construction. Can they add some other parts of the market that are more protective of inflation? So think about gold, infrastructure, private markets. When you put that resilient portfolio, then your portfolio is very much against a potential resurgence in inflation.
How much is the earnings upside that we've seen and that you forecast going forward in the upcoming earnings season is underpinned by spending on AI?
Great question. I think it's a combination of two things. One is absolutely we're seeing a very strong, capex cycle that is happening since the first quarter of this year, even earlier than that. That is absolutely impacting the market. AI is leading the charge at this point. But then also the Fed cutting cycle should potentially impact the rest, 493 companies in the United States of America. If we think about, for example, financials, they should do well when the Fed is cutting. That should give potential loan growth. That should be good for the M&A IPO activity. So yes, we're seeing a very good picture on the AI side, but let's not forget that the Fed cutting cycle should be also good for more cyclical parts of the market.
And financials are amongst your favourite sectors right now for the rationale that you just unpacked for us. But as are utilities, and that ties back to the AI story, when does the AI infrastructure spend really start to accelerate the earnings story for utilities?
We're already seeing that, right? If we're looking in the last 10, 15 years, we really didn't see that big earnings growth in the utilities sector. But now we're this completely new era where the AI infrastructure is probably increasing the earnings growth for utility sector because we just need more power. And with all the news that we've seen in the last, call it 1 month, that definitely underpins very positive picture for the US utility sector.
You focused a fair bit on the earnings story in the US, and the divergence in terms of the US earnings story versus European is pretty stark. When do European earnings start to turn around? You're pretty constructive on Europe as well. When does the earnings story of Europe start to catch up? When do we start to see real positive momentum in the European earnings story?
We think that's probably the question for the 2026, because this year the earnings in Europe have been impacted by FX, but also tariffs. What we need to see now is the German fiscal stimulus actually impacting the more cyclical parts of the market.
Do you want a position for that now?
Absolutely, yes. Because we think that we're probably at the very last stage of the negative earnings revisions in Europe. And interesting, when you look into the valuation, Europe still trades at 15 times PE. So the market really tries to position themselves for a potential resurgence in earnings revisions in Europe next year.
Which part of the European equity space are you leaning into, or do you want to be leaning into at this point?
We have been very constructive on industrials for a very long time, and we do continue to have this conviction despite a very strong performance, because there are multiple global secular themes that industrials are part of. AI is definitely one of those stories, but also the German stimulus should be positively impacting the sector.
And you mentioned euro strength as one headwind that is factored into slightly softer European earnings. Do you assume that euro strength continues as a 2026 theme on softer dollar, or are we starting to see a more equilibrium in terms of that currency pair?
I think equilibrium is a nice word to say. We think that the pace of the move is probably behind us. We don't think that the impact will be as large as we've already seen in 2025. And that's an important point, because a lot of multinational companies have been punished and the earnings have been impacted by FX move. If the FX move become less pronounced next year, that should be positive for that part of the market.
OK, Nataliia, thank you very much indeed. Really smart insights, and factoring in, of course, news of the day in terms of how to think about these markets. Still constructive on US equities and the earnings story as well in that segment of the market, and possibly more to come in terms of the European equity story when that stimulus from Germany really kicks into gear. Nataliia Lipikhina, head of EMEA equity strategy at JPMorgan Private Bank. Coming up, securing the skies. NATO Secretary General Mark Rutte tells Bloomberg the alliance is ready to protect the airspace of members. We bring you that interview shortly. This is Bloomberg.
It is not sustainable that you would take down $1,000 or $2,000 costing drones with missiles which cost you maybe $500,000 or $1 million. So this is why our Supreme Allied Commander in Europe, together with the colleague working on transformation, all of us in NATO are rapidly developing the technologies, learning from the Ukrainians.
NATO Secretary General Mark Rutte, of course, on deploying new technology to counter Russian drones. Now, we're told the British, French and German diplomats have held a tense meeting with Russian officials in Moscow about incursions into NATO members' airspace. Russian officials deny their planes crossed into Estonian skies last week and said that a separate incident when drones crossed into Poland was the result of what they've described as an error. It comes as Denmark's Prime Minister warns the nation to brace for more hybrid attacks, pointing to Russia as Europe's main security threat. Hybrid warfare is a mix, of course, of unconventional and conventional tactics. This came just before a suspected drone sighting disrupted air traffic in Denmark for the third time in a week. Let's get more from Russian economy and government editor Greg Sullivan right now. Greg, what have we learned about these private talks then in Moscow?
Well, from what we know, the Europeans are really trying to put forward a tough line. They said that they're willing to respond to these attacks more forcefully, including potentially by shooting down these jets. Now, for NATO, this is a huge challenge for them on many fronts. We don't really know why the Kremlin is doing this, but it could be a number of things, including testing NATO resolve or even testing NATO air defenses, seeing what and when NATO and how NATO would respond and win to certain incursions. You mentioned the hybrid tactics. These are frequently employed by Moscow as it looks to test Europe, but also to try to undermine the resolve for Kyiv's European allies. We know that Putin has no intention of stopping his war in Ukraine, and this could be a signal from the Kremlin that those that support Kyiv should be ready to face a more respondent Russia on that front.
Greg, we've got the elections in Moldova this weekend. How is what Russia is doing playing into that election? There have all been concerns about and risks about interference, and clearly Russia has a track record of interfering in elections. Is that what the key risk is this weekend? How significant could this event be?
Well, for the Kremlin, they certainly don't want to see Moldova go down the path of the European Union. They would prefer to see Moldova stay in their orbit. Of course, the current president, Maya Sandu, is very pro-European. Last October, there was a referendum in the country about joining the EU, and it passed narrowly. Russia has taken efforts to try to influence the outcome of these elections and referendums. Obviously, they do want them to stay in their orbit. So, that even prompted Ukrainian President Zelensky to say that the world needs to make sure that Russian influence doesn't prevail in Moldova. It is a divided country. Part of the country, it does look towards Europe. While there is a sizable Russian-speaking minority there, it's also facing high inflation and cost of living. So it's a pivotal election for Moldova as it looks to inch closer to the European Union. And that's something that the Kremlin obviously does not want to see.
OK, an event we will continue to monitor and watch over this weekend. Russia Economy and Government editor Greg Sullivan with that update. Greg, thank you. Let's stay with Russia then and take a look at the economy there and the global economic risks tied, of course, to the events in Russia. And bring in Sergei Guriev, Dean and Professor of Economics at London Business School, joining me around the desk this morning. Sergei, thank you for your time. I want to start with your top-line view on the current health of this Russian economy as it continues to pursue the conflict in Ukraine.
Right. The overall view is Russian economy is stagnating. It's on the verge of recession, but not really in recession. The growth driven by military spending is over. In 2023 and 2024, Russian economy was growing at 4% a year. This year it will be probably 1%. The first quarter was actually negative, second quarter near zero, but positive. And we can see how Russian fiscal resources are being depleted. Russian government just announced it's going to raise taxes, moving, for example, VAT rate from 20 to 22%, and drastically increasing taxes on small businesses as well. So there is a fiscal pressure, but it's not catastrophic. Russian government still has sovereign wealth fund. It's depleted. It only has 2% of GDP in it, in its liquid part. But there are alternative opportunities to finance the war. And I think as long as Putin continues to advance on the battlefield, it shows us that he has enough resources, human resources, military resources, economic resources to continue this war.
I want to go further in terms of the linkages between the economic health of Russia and its ability to pursue that conflict. But in terms of your medium-term outlook, because we've seen Russian officials downgrade their medium-term outlook growth for next year, for 2026. What is your view in terms of how the growth story evolves next year for Russia?
It's going to be a slow growth, and Russian economy is actually very complex, being essentially two economies, a military economy and a civilian economy. Military economy will continue to grow, albeit much slower, at a much lower rate than before. Civilian economy is stagnating, suffering from high wage growth, driven by demographic challenges, a million people killed or wounded, a million people emigrating. Also suffering from high interest rates. Russian central bank is lowering interest rates, but they're still staying at 17%. And Russian central bank said it's unlikely that it will come down further because inflationary pressures remain.
So interest rates at 17%, and you talked about the financial system. You say it's not facing necessarily a crisis. Is that my understanding? How much pressure is the financial system of Russia under right now?
So it's very hard to evaluate the health of Russian banking system. Russian banking system is dominated by the government banks. About 80% of banking assets are within the state banking system. So these banks take direction from the state. Formally, they are independent, but in reality, they take direction from the state. And if Russian government says, we need to borrow domestically, please buy our bonds, they do. And in that sense, there is some liquidity in the banking sector that can help finance the war still.
How vulnerable is this Russian economy to any further reduction in international purchases of oil? President Trump is clearly putting pressure. We can debate how much pressure and whether it's enough pressure on countries like Hungary, Turkey to some extent, India, to try and reduce their input or at least their purchases of Russian oil. How vulnerable is the economy to any changes on that front?
So the story about Hungary and about India are two different stories.
Okay.
So Hungary is buying very little of Russian oil. It will continue to buy Russian oil. European sanctions did not introduce embargo on countries like Hungary simply because Hungary said otherwise we'll block this sanctions package and further sanctions packages. Well, India has become a major buyer of Russian oil, and the previous U.S. administration told India you can buy Russian oil as long as you comply with the oil price cap. So the idea was Russian oil stays in the market, so global oil market is well supplied, but we take away petrodollars from Putin and give them essentially to Indian fiscal coffers. Now, this administration says, you don't need to buy Russian oil at all. We don't like that. And Indian government is lost whether it should actually follow the previous government's, US government's policy, which was part of the whole sanctioning coalition strategy, or the new policy, which is actually not supported by European allies.
Given all the incursions that we've seen in recent weeks, we have to start to think about the possibility, as unpleasant as it is, of a potential conflict between NATO and Russia. Is Russia's economy resilient enough to pursue a conflict with NATO?
Well, we don't know, and this is what Putin is testing now. He wants to understand, is NATO actually prepared? Is NATO actually united? Will US support European allies in deterring Putin? And Putin wants to understand how costly this war may be. And the other goal he's probably pursuing is to make sure that Europeans understand that they need their own air defense and should not send military support to Ukraine. So he's creating this distraction for the European NATO allies, sending the message, you need your own air defense at home. Don't send weapons to Ukraine.
China has been a crucial economic partner to Russia. Is Russia the junior partner in that relationship? How dependent is Russia on China, and is that a vulnerability longer term?
It is absolutely dependent. It is a junior partner, if you can still use the word partner, because it's some people would already say vassal. So in the sense that Russia is totally dependent on China. China is the only supplier of technology to Russia after sanctions introduced as early as 2022.
OK, and briefly, before you let you go, you are the Dean of the London Business School, an esteemed establishment here in the UK. And you've recently launched a Corporate 100 Alliance. What is it? Why now?
Yes, that's been a good week for London Business School. London Business School is a global institution which is especially important in those days of fragmented and polarized global environment, as we just discussed. And this week was very good. We just announced a landmark historic gift of £25 million to establish a endowed research institute on longer lives and careers. And we also launched Corporate 100 Community, which is one-of-a-kind partnership with global corporations coming together to study and learn from our esteemed faculty, but also from each other. We just announced that the first founding partners include Rolls-Royce, Nestle, Deutsche Bank, Vion, and we will continue bringing this community together. This is a unique initiative where we build a corporate community with unique access to LBS resources for all layers of those global organizations.
Professor, thank you very much for your time.
Very much.
Professor and Dean at the London Business School, of course, Sergei Guriev, with that analysis as well in terms of the health of the Russian economy. Coming up, President Trump and his Turkish counterpart Erdogan meet at the White House. Part of their conversation was indeed about Turkish oil purchases. More on what Trump is pushing the Turkish president to do and the deals they have struck. That is next. This is Bloomberg. Good morning. Welcome to The Pulse. I'm Tom Mackenzie in London. Happy Friday. These are your stories. President Trump says he will impose a 100% tariff on branded drugs next month, but companies building plants in the US will be exempt. He's also announced new levies targeting heavy trucks and kitchen cabinets. European stocks rebound from three-week lows, shrugging off broader tariff worries while Asia sinks. And Bloomberg learns that European officials are privately warning Moscow that they are ready to shoot down Russian jets. Let's check in on Intel pre-market. We're seeing a pop on the back of reports that the Trump administration is looking to curb the import of chips into the US market. They are looking at a one-on-one structure where you get one import for one chip produced in the US market. We're waiting for more details, but clearly Intel, with its changing fortunes, particularly around its liquidity and recent investment from the US government alongside Nvidia, SoftBank, and conversations with Apple, getting a lift this morning, up 4.8% on that chip story that is being reported, and that is something we'll keep across for you, of course. So watch that stock at the open, State time, of course, up 4.7%. Now, President Trump has signed an executive order which advances plans for American investors to buy TikTok's US operations to another part of the tech space right now. The spin-off cuts ByteDance's stake to less than 20%, as required by the national security law. Vice President J.D. Vance said the deal will value the new US company at around $14 billion, much lower than previous projections of up to $40 billion. Beijing says the US still needs to, quote, provide a fair environment for Chinese investors, though Donald Trump says President Xi Jinping has given the deal the thumbs up.
This is interesting because I had a very good talk with President Xi, a lot of respect for him. Hopefully he has a lot of respect for me too. And we talked about TikTok and other things, but we talked about TikTok, and he gave us the go-ahead. You know, it's run by American investors and American companies.
Meanwhile, former FBI Director James Comey has been charged with lying to Congress and obstruction related to testimony he gave in 2020. If convicted, he could face up to 5 years in prison, the Justice Department has said in a statement. Comey has, of course, clashed with President Donald Trump for years, and this move accelerates Trump's push for legal action against his perceived political enemies. Comey has denied the charges.
My heart is broken for the Department of Justice, but I have great confidence in the federal judicial system, and I'm innocent. So let's have a trial.
Now, US President Donald Trump has urged Turkish President Recep Tayyip Erdogan to halt Russian oil purchases. He also left the door open to Turkey obtaining F-35 fighter jets as the leaders met at the White House. Let's now bring in Bloomberg's Ona Ant, who's been watching this for us with the context and the details. Ona, what is it that President Trump is seeking to get then from Erdogan? This, I believe, is the first visit by the Turkish leader in, 6 years?
That's right. This was the first White House visit by President Erdogan since 2019. And as you said, the key demand from the Turkish president by Trump was that Turkey curb energy imports from Russia and specifically hold all crude oil imports from Moscow. Now, that is a big ask, considering the fact that Russia accounted for about 2/3 of all oil imports that Turkey had in 2024. Having said that, on the other hand, Turkey does have other alternatives, including crude oil from neighboring Iraq. And over the weekend, we are likely to see the resumption of Kurdish oil flows from that region. In return for this demand from Turkey, Trump kept the door open for a possible resumption of F-35 sales to Turkey and possibly bringing Turkey back into the F-35 development program. It's been a problem that's going on years between the two countries, since at least 2019, which is when Turkey was ejected from that program. And it's critical for policymakers in Ankara to have access to, again, basically high cutting-edge aviation technology, because of the fact that Turkey now feels that its air force is aging and it's kind of behind regional rivals such as Greece and Israel. So it was a very transactional meeting between Trump and Erdogan. Trump, on the one hand, asked Turkey to cut down oil imports from Russia. We don't know yet what exactly Erdogan has agreed to, but President Trump said he believes that Erdogan will do the right thing. And in return, he's offering Turkey various things, various deals, including possible purchase of F-35s and F-16 fighter jets from the U.S.
OK, so those are the military components of the talks. What about the civilian part when it comes to deal making and the stage that Boeing takes whenever President Trump is meeting these leaders? It seems to be an emphasis, or at least a priority of the president to try and notch some numbers on the board for Boeing.
That's true, and yesterday's meeting was no exception in that sense, Tom. We knew that Turkish Airlines and Boeing were on the cusp of a deal. This is something that we reported on about a week ago. And yesterday, after the meeting, it was clear that Trump and Erdogan had agreed on something. They indicated that, but they didn't quite say what it was. So this morning, Turkish Airlines itself said that it was going to buy as many as 225 airplanes from Boeing. Now, some of that orders are firm, some of that are conditional on deals with some engine makers, but it's clear that Turkish Airlines is going to buy a huge number of airplanes from Boeing, and the deal is probably going to be worth something more than somewhere close to $20 billion or more, and it just shows, again, underlines the same thing. Yesterday's meeting was very transactional, and Turkish Airlines is definitely one big diplomacy tool for Turkey. It's something that Turkey actually used way back 20 years ago to jumpstart talks with the European Union by ordering a huge amount of airplanes from Airbus. And this time around, it looks like Erdogan used this as a leverage to get at least some of the things that he wanted from Trump during his White House meeting on Thursday, Tom.
Okay. An important update, Bloomberg's owner, and thank you very much indeed on that meeting between the two presidents, of course, in the Oval Office and the deals that have transpired on the back of that. To macro policy now and the banking space in Europe, because the ECB, in its push, of course, to simplify bank rules, German proposals to radically streamline capital structures have become the most contentious issues. There are concerns that the suggested changes could lead to new capital demands for some lenders and reduced harmonisation across the Eurozone. The debate is live. Banks worry about being disadvantaged by the wave of deregulation sweeping through the US and to a lesser extent here in the UK as well. Joining us now is Andreas Dombret, former ECB Supervisory Board member and currently at Pharma as well. Deep experience, of course, across the European banking space. Thank you very much for your time. I actually want to start on the rates environment because we're at a moment where there appears, Andreas, to be quite significant divergence between the Fed and the ECB. The Fed appears to be set to cut in an environment where they are not reaching their inflation target. Inflation around 3%, the target around 2%, whereas the ECB is on hold at a time when there are some suggestions that we're entering a deflationary environment. At least inflation is looking far more benign in Europe. How do you explain that divergence? Is one of those central banks setting itself up for a policy mistake?
We haven't seen these divergences in the past. So it's quite new, and many people in the market have been talking about this. It never really happened. Now we're seeing it. If you look back to summer of last year, we've had 8 declines in the European policy rate and now 2 pauses. The US has done just the opposite. They have been pausing and now they're declining. So they're no longer 100% in sync, to say the least. Now, in Europe, I can only tell you in the Eurozone that we have quite good economic stimulus and a situation. Whether you look at the Purchasing Manager Index, whether you look at the indicators at MI, you look at how lively the lending of the banks is happening, I think that we're going to grow by 1.4% of GDP this year, maybe 2% next year. The economic situation, as you rightly say, isn't that bad at all, which could mean that my forecast would be that we're going to see in the next 2 monetary policy meetings on October 30 and on December 18, we're going to see another pause. There is a very small likelihood of an increase, which I don't see, but it's more likely than lowering further.
OK, so they pause at the next 2 meetings, the ECB, and that's important, of course, coming from your background on the Supervisory Board and at the Bundesbank. And you're projecting growth of 2% in 2026, potentially for the Eurozone. Does that put rate hikes on the table for the ECB?
Let's see when we get there. You have to decide data dependent, but it is tilted towards that rather than the other way around. So I don't think that this makes sense now. That to hold rates steady for the rest of this year makes most sense, and that's what the data, I think, says. But let's see what we get next year and how strong the economic situation is. But we're seeing better data coming in now than we saw for a long time. So it could be that at some point we're going to have to change course in terms of interest rates.
What proportion of that 2% growth that you forecast next year is coming from German fiscal stimulus?
No. That is hard to say. Germany is, of course, lagging, but it's stabilizing. I personally believe that we're going to have a growth rate in Germany of 1% plus, which is roundabout trend growth, which has come down. So Germany, which has had 3 years of sideward movements or a technical recession, however you want to call it, is catching up again, and the stimulus is playing a big role.
I want to talk about banking consolidation. We've seen some moves, whether it comes to UniCredit and its attempts and building out of stake in Commerzbank, of course. Over in Spain, there's a lot of activity, in Italy as well. Are we finally at a point, Andreas, where banking consolidation is happening in Europe?
obviously, in Italy, the two deals are basically done. In Spain, they're coming to an end now, and probably the Sabadell shareholders are well advised, I'm not advising them, but well advised to accept that offer. So there is a likelihood, a higher likelihood of BBVA, winning this transaction than the other way around. And in Germany, we have a very determined UniCredit with regard to Commerzbank. The share price of Commerzbank, I feel difficult to interpret because there's so much derivative music in it, if you want to call it that way. It's very, very difficult to see. So the long-only investors, I think, they sold out or they're selling out because they see that this is maxing out. The hedge funds, they say, with all this derivative music, if I can use this term again, hard to interpret, but clearly there's more downside on the share price than on the upside as we stand now. It's going to trade in a range because the market will say that at some point, if the share price drops too much, of course, UniCredit will buy. Plus, since yesterday, Commerzbank is exercising its €1 billion a share buyback. So it's going to run until February. There are going to be some buyers in the market. Yeah. By the way, at 1.4 times book and not at 0.4 times book as in the past. So the accretion is very different. So I am not quite sure how this will play out. The price of Commerzbank is not low at all. It's a full price, and I don't know, and I don't have any indications what this will mean. But there is the share price is not necessarily an indicator of what the market wants with regard to Commerzbank.
Is it also a reminder that national bank consolidation is easier in this environment than cross-border consolidation? Yeah. And to what extent does that need to change?
That is all. These are all national borders. Maybe if, the UniCredit approach is an approach which looks like a cross-border approach, but of course the idea is to merge Hypovereinsbank and Commerzbank in whichever way or form. I'm not informed. So the same is true in Italy. The same is true, of course, in Spain. So we are seeing domestic mergers, and we saw a domestic merger in Switzerland, if you want to call it a merger.
Yeah.
That is not in the Eurozone or in Europe, but it's still very close.
I need to ask about your role at the most valuable fintech in Germany. You've taken the board at N26. They face some regulatory scrutiny as well. You've come on board with your deep experience, presumably to try and set that company on the right footing. Are you expecting to make any additional changes to the management? Are you comfortable in terms of how things are progressing? What's your first priority at N26?
I have not taken the role yet. I'm only the designated chairman, so I'm going to stay away from answering this. But I can tell you, the market is an interesting market.
Yeah.
If you walk around in the market and speak to market participants, all they're going to talk about right now is Revolut and their plans. Yeah. So this is an interesting market. But let me first arrive and land before I make any statements.
Okay, fair enough. Well, we'll come back to you then once you've landed N26. We really appreciate your time, of course, and your thoughts on banking consolidation and the rates environment as well. Andreas Dombret, of course, former ECB Supervisory Board member, with those insights. Now, hedge fund manager David Einhorn is sounding the alarm on AI spending, warning that it may destroy vast amounts of capital, even if the technology itself proves transformative. The Greenlight Capital founder says the $1 trillion build-out by companies is so extreme that investors may not see the payoffs they anticipate. He spoke during a panel discussion hosted by Simplify Asset Management at the New York Stock Exchange last night.
The numbers that are being thrown around are so extreme that it's really, really hard to understand them. I'm sure a lot of the stuff is going to get built. Whether it gets built at the amounts, I don't know. And whether there's a return on this, like what the revenue stream is of actually people using the output and paying for it, I also don't know. This seems highly uncertain. I'm sure it's not zero, but there's a reasonable chance that there's a tremendous amount of capital destruction that is going to, come through this cycle.
Coming up, a crucial moment for the UK Prime Minister Keir Starmer as we look ahead to the Labour Party conference. Details are next. This is Bloomberg. Welcome back. Now, there will be a lot of focus, of course, on the UK Prime Minister Keir Starmer on Sunday when the Labour Party conference kicks off in Liverpool. Aside from fiscal constraints, of course, and rumbles of division amongst the governing Labour Party, the party is facing some tough political decisions, of course. Could it be a challenge for the Prime Minister? I think the answer to that one is certainly yes, and the fiscal constraints up front and centre. We felt some of that this week in terms of the challenges around some of the bond auctions by the debt organisation, or the debt office, I should say, here in the UK, and question marks about how much demand there is right now for UK debt. And a reminder, of course, that investors are concerned as we lead up to the budget in November. Before we get there, of course, the Prime Minister's speech on Sunday. Let's bring in then, at this point, Bloomberg opinion columnist Rosa Prince, alongside Bloomberg's Joe Mays, author as well of the new book, Can You Run the Economy? That you can see there on your screens. And the timing of this is fantastic and well worth, of course, your time. Let's bring in Rosa first, though, before we get to Joe in the book. There is, of course, let's start with the politics and the potential challenges for Starmer politically with the fiscal backdrop. What are you going to be watching for in terms of how he frames that speech on Sunday?
Yeah, well, as you say, it's terrible timing for Keir Starmer to have to address his conference this weekend. He's had an awful few weeks. He lost his Deputy Prime Minister to a scandal. He lost the US Ambassador to a scandal. And now that's all led to Labour MPs being very unhappy and talking up the prospect of a challenge to his leadership, which seems incredible given he was only elected just over a year ago. So the Mayor of Manchester, Andy Burnham, is their guy. He's not in Parliament, so it's kind of difficult for him to take over, but it's certainly on everyone's minds going into conference. And
Joe, it's interesting to hear from the Prime Minister in reference when he was being asked about the challenge by Andy Burnham, talking about a Liz Truss moment, because Andy Burnham has made proposals that would involve a lot of spending. The fiscal challenges, before even Andy Burnham is factored in, for Rachel Reeves and the Chancellor, something, of course, you've been thinking deeply about with the book, they are pronounced. Where are we on that challenge, and how you think this government could try and address that challenge in the lead up to the budget?
Well, we know that Rachel Reeves has this very big black hole in the public finances, largely because we know the OBR is going to downgrade estimates for productivity of the UK economy, and every time 0.1 percentage point goes down, billions more get added to her black hole. So that's why we're talking about the need for tax rises across the piece to try and fill that gap. Now, Rachel Reeves wants to keep a positive message. So that's why I think we can expect lots of announcements around growth in the build-up to her budget, to try and maintain some of the optimism. But then she'll have to hit us all with those higher taxes to fix the public finances. OK, so that's on the tax piece, and that seems almost inevitable at this point to the kind of the emphasis that you're putting on that question as we lead up to November. And we'll see if they nod to that in these speeches over the next couple of days. Rosa, when it comes to the domestic political environment, you've talked about the challenges and the divisions amongst the governing Labour Party. There are some policy proposals and some that are quite eye-catching. They're being reheated, which is IDs, for example, digital IDs. What do we know about that, and whether or not that is a real prospect and the timeframes around when that gets implemented?
Yeah, well, the other big challenge for Keir Starmer, alongside his leadership, alongside the budget that's coming down the track, is the threat from Reform UK. That's the kind of upstart, quite right-wing party led by Nigel Farage that take a lot of inspiration from Donald Trump and the MAGA world. Now, obviously, their big kind of campaign issue is immigration. Keir Starmer thinks he has something to help him tackle that. Those questions of immigration, questions about the small boat arrivals that are very unpopular with the public. And he thinks the answer is a digital ID card. And that would mean that you would have to have your ID checked by an employer before you could work here. He thinks that means that people would be put off coming to the UK, no longer see it as a kind of soft touch where it's easy to work. Unlike other European countries, most European countries do have ID cards of some form, and so the idea is that migrants are leaving those countries, coming to the UK, and Keir Starmer wants to stop that.
OK, so we'll watch to see if we get more detail on that in terms of how it's implemented as well. Joe, look, your book is to some extent a framework in terms of how to manage the budget, how to win an election. Maybe Nigel Farage and maybe even Andy Burnham should be reaching for a copy of said book. Joe, talk us through kind of what went into it and how you're thinking about what is in the book now and how it translates into the current situation for this government.
Yes, here it is. And asking the question, can you run the economy? I wanted to have a fun, engaging, interactive way to bring this topic to life and really make you feel the pressure of how difficult it is to have to manage the finances, have to say no to the Prime Minister, have to say no to your MPs, because you have to keep the finances in good order. And if you don't, you risk the consequences of a Liz Truss-style moment, the bond market's moving against you. Now, these are very real threats and prospects that Chancellor faces. And I wanted to try and bring that to life the best I could.
Maybe some of the backbenchers could do with reading it as well.
I think Rich might recommend it to them. I would suggest that.
Yeah, I mean, but it is interesting when you interact when you go out and about and you talk to friends and family, and when you frame it around the necessity of thinking about the bond markets and how some voters are not factoring that in, and clearly that is part of the book in terms of how, in terms of the fiscal constraints that most governments are facing, and of course this is a situation for France as well. But you're very much focused, of course, here in the UK. Joe, thank you. That is the book. Can you run the economy? It's your turn to be Chancellor. Of course, originally based on the game that you built out for Bloomberg, right?
Bloomberg had a game along these lines, and then luckily a publisher saw it and said, can you make it into a book? And so I have.
Okay, fantastic. Joe, thank you very much indeed. Well worth your time, whether you're Nigel Farage, Andy Burnham, or anyone else who has concerns and wants to be thinking more deeply about how to run the economy, the finances of the UK government. Rosa Prince, of course, from Bloomberg Opinion, thank you for your insights in the lead up to that speech on Sunday by the UK Prime Minister. Back to our top story right now. President Donald Trump has announced a fresh round of tariffs targeting a broad range of sectors. That includes a 100% duty on branded or patented pharmaceuticals starting October the 1st for any company not building a manufacturing plant in America. He also plans to impose levies on heavy trucks, kitchen cabinets and upholstered furniture. Let's unpack all of this. I like that, with Bloomberg's Katia Dimitrieva. Katia, what more do we know about these tariffs?
Well, we're going off of Trump's social media because, of course, we don't have anything officially from the White House yet. But what we do know is that, like you said, 100% tariffs on pharmaceuticals, but specifically patented pharmaceuticals and those without operations in the U.S. yet, of course, so that carve-out is helpful. And we also had a 50% tariff on household goods, things that go into apartments and houses across America, like bathroom vanities and kitchen cabinets. There was 25% tariffs on heavy-duty trucks and imports. So we know that these are going to be coming into force pretty quickly, so not a lot of negotiating room for countries or companies. We're expecting them to come in next Wednesday in the U.S., and it'll probably be implemented much in the same way that we've had in prior cases. So you'll see this being charged at the border. Now, the other thing, I mean, there's still a lot of questions, as we've had with previous tariff announcements. So one of the things that we're wondering is, do these tariffs stack on top of already existing tariffs with a country? So we had those reciprocal day levies. Are they being stacked on top of those, or is that the level? So the EU, for example, had negotiated a trade deal with the US with 15% pharmaceutical levies. So is that the level we're looking at, or are we now looking at 100%? So these are things that hopefully will be answered in coming days.
OK, we await more detail. And Sam Fazeli of Bloomberg Intelligence saying that maybe the pharmaceutical tariffs and the 100% maybe not as concerning as maybe the headline suggests, given how much manufacturing and production is being done in the US already. Bloomberg's Katia Dimitrieva with the context, of course, on these additional tariffs being announced by US President Donald Trump and their implementation, how that is likely to impact supply chains and various different sectors, of course. Now, we will be speaking with Richmond Fed President, by the way, Tom Barkin, later today. That conversation starting at 12:30 p.m. London time, on a day, of course, when we get fresh inflation data out of the US. And as traders start to pair their bets in terms of Fed rate cuts through the end of this year, the FOMC is divided. We'll hear from Tom Barkin. Let's get back to the markets right now before we wrap the show. European stocks up 0.3%, looking through the tariff risks, though. US futures, S&P E-mini is currently flat after 3 straight days of losses. We'll see if turn and sentiment turns around on the inflation data. That comes out at 1:30 p.m. UK time. Up next, Bloomberg Brief. This is Bloomberg.